You think your money is safe and growing, but every single month you're silently losing thousands in potential wealth without even realizing it. A high-yield savings account makes you feel smart, and that feeling is exactly what's holding you back. Let me ask you something. Imagine you found a vending machine. Every time you put in $1, it spits out $1.04. Not bad, right? Free money, easy money. You feel smart just standing in front of it. Now imagine, just around the corner, maybe 30 seconds away, there's another machine. You put in $1, and over time it gives you back $3, $5, sometimes even $10 or more dollars. But you never walk around the corner, because the first machine feels safe. It feels certain. And certainty, it turns out, is one of the most powerful psychological traps in personal finance. Most people with a high-yield savings account are standing in front of that first machine, proud of themselves, while a much better machine sits just around the corner, untouched. And today, I want to show you what's around the corner, and more importantly, I want to explain why your brain fights so hard to keep you from walking there. Okay, let's back up. A few years ago, high-yield savings accounts, or HYSAs, became the darling of personal finance content. And honestly, for a while, for good reason. Traditional savings accounts at big banks were paying you something embarrassing, like 0.01% interest. That means if you had $10,000 sitting in a regular savings account, you'd earn about $1 a year. $1. You'd make more money finding a coin on the sidewalk. Then along came HYSAs, mostly from online banks, Marcus, Ally, SoFi, Marcus by Goldman Sachs, offering 4%, sometimes even 5% interest. Suddenly, people were getting $400 to $500 on that same $10,000. That's real money. That feels good. And so the internet went crazy. Every finance influencer was saying the same thing: move your savings to a high-yield savings account immediately. And look, that advice wasn't wrong for that moment. Getting 5% on your emergency fund beats 0% any day of the week. But here's where the story gets complicated. Most people didn't stop there. They started treating their HYSA like an investment strategy. They parked bigger and bigger chunks of money in it. Money that wasn't just for emergencies. Money that was sitting there for months, sometimes years, doing its little 4 or 5% thing, while the people who understood the game were doing something completely different with theirs. And here's the uncomfortable truth nobody really talks about. That 4 or 5% rate it's not permanent. It's not even guaranteed for next month. And the opportunity cost of keeping too much money in that account might be quietly costing you tens of thousands of dollars over your lifetime. Let's break down exactly why. First, let's talk about what a high-yield savings account actually is. It's a savings account. That sounds obvious, but the word savings is doing a lot of work there. Banks pay you interest on your deposits because they take that money and lend it out to other people at higher rates. They keep the difference, you get a small slice of it. The rate they offer you is directly tied to something called the federal funds rate, basically the interest rate set by the U.S. Federal Reserve. When the Fed raises interest rates, HYSAs go up. When the Fed cuts rates, HYSAs go down. You have zero control over this. And this is crucial. From 2022 to 2024, the Fed raised interest rates aggressively to fight inflation. That's why your HYSA was suddenly 5%. It wasn't because banks suddenly got generous. It was because the economic environment temporarily made it happen. But interest rates move in cycles. They always have. The Fed has already started cutting rates, and history shows us that these high rates won't last forever. The HYSA that was giving you 5% last year might be giving you 3.5%, then 2.5%, back to something that barely beats inflation within a few years. So what's actually happening when you keep most of your money in a high-yield savings account? Let me give you a simple example. Say you have $20,000. You put it in your high-yield savings account at 4.5% interest. After 1 year, you have about $20,900. Nice, you made $900. Now, say your friend takes that same $20,000 and invests it in a simple, low-cost index fund that tracks the S&P 500, basically a basket of the 500 biggest companies in America. The S&P 500 has returned an average of roughly 10% per year over the last several decades. Not every year, of course. Some years it drops, some years it goes up 25%. But over time, that 10% average holds up remarkably well. After 1 year, your friend's $20,000 could be worth around $22,000. That's an $1,100 difference in year 1 alone. Now, here's where it gets really interesting, and this is the part that most people never sit down and actually calculate. Leave that $20,000 alone for 20 years. In the HYSA, at a conservative assumed rate of 3% over time, your $20,000 grows to roughly $36,000. In the index fund, at 10% average returns, that same $20,000 grows to roughly $134,000. That's not a typo. 36,000 versus 134,000. Same starting amount, same time, just a different machine. This is what's called opportunity cost. Every dollar sitting in a low return account is a dollar that isn't compounding at a higher rate somewhere else. The money you don't make is invisible. You never see it leave, but it's leaving all the same.
Now, here's where psychology comes in. Because you might be thinking, okay, this seems obvious, why don't more people just do that? And the answer is one of the most deeply studied biases in all of behavioral economics: loss aversion. Humans are roughly twice as sensitive to losses as they are to gains. That means losing $100 feels about twice as painful as gaining $100 feels good. We are wired, deep in our brains, to avoid uncertainty, even when uncertainty is actually the smarter long-term play. When you have money in an HYSA, you watch it grow every single month. There's a number, and it goes up, slowly, reliably, predictably. That predictability triggers a sense of safety and control. Your brain releases a tiny bit of dopamine every time you see that interest payment hit. The stock market, on the other hand, goes up and down, sometimes violently. In 2022, the S&P 500 dropped about 18%. If you had $20,000 invested, you would have watched it become $16,400 on paper for a while. And that experience, watching your number go down, is so psychologically uncomfortable that many people pull their money out at exactly the wrong time. They lock in the loss, they retreat to the safe account, and they tell themselves a story about how they're being smart. But here's the thing. Long-term investors who stayed through that 2022 drop watched their money fully recover and hit new highs by the end of 2023. The pain was temporary. The missed recovery would have been permanent. There's also something called the certainty effect, our tendency to overvalue guaranteed outcomes compared to merely probable ones, even when the math clearly favors the probable option. A guaranteed 4% feels better than a probable 10%. Even over 20 years, the probable 10% wins by a mile. Your HYSA isn't just a financial product. It's a comfort blanket, and there's nothing wrong with comfort until that comfort starts costing you your financial future. So what should you actually do? Let me be clear. I'm not saying HYSAs are bad. I'm saying most people are using them wrong. Here's a framework that actually makes sense. Your HYSA is for your emergency fund, period. Most financial experts suggest keeping 3 to 6 months of living expenses liquid and accessible. If your monthly expenses are around $3,000, that means $9,000 to $18,000 sitting in your HYSA. This money is your safety net. It's not meant to grow fast. It's meant to be there when your car breaks down, when you lose your job, when life happens. For this specific purpose, an HYSA is actually perfect. It earns a bit of interest, it's FDIC insured, and you can access it quickly. But everything beyond that, money you don't need within the next few years, that money has a different job. That money's job is to grow. And the simplest, most time-tested way most people can do that is through index fund investing. Low cost, diversified, long-term. You don't need to pick stocks. You don't need to be a financial genius. You just need to start, be consistent, and have enough patience to let compound interest do its thing. The third tier is for specific goals 2 to 5 years out, maybe a down payment on a house, maybe a car. For these, you might look at options like treasury bonds, I-bonds, or short-term bond funds. Still relatively safe, but often offering better returns than a savings account over that time frame. The key insight is this: not all money has the same time horizon, and not all money should live in the same place. When you treat every dollar as if you might need it tomorrow, you rob every dollar of its ability to grow for your future. Let me leave you with this. There's a concept in investing called the cost of waiting. Every year you delay investing, the timeline for compound growth gets shorter. The $10,000 you invest at 25 will likely be worth far more at 65 than the $10,000 you invest at 35, even if you invest more total dollars later. Time is the one resource in wealth building you can never get back. A high-yield savings account tells you a comfortable story. Your money is safe, it's growing, you're being responsible. And that story isn't entirely false. It's an incomplete story. The complete story is your emergency fund is safe, your short-term money is protected, and your long-term money is out there working for you in the market, compounding quietly, building something your future self will be genuinely grateful for. The richest people in the world don't get rich by keeping their money somewhere comfortable. They get rich by being comfortable with a little discomfort and letting time do the heavy lifting. The question isn't whether a high-yield savings account is bad. The question is, how much of your future are you willing to trade for the feeling of certainty today? Think about that. And if you're ready to actually understand how to start investing simply and how to stop letting your money sit idle, make sure you subscribe, because that's exactly what we're breaking down next.